Hi there, welcome to Kneppy Invest. In today's video, I'm going to be looking at Woolworths and their financial year 22 results. Some really interesting results here. This company grew their revenue nearly 10% from last year, which might suggest this company is almost quickly growing. So I'm looking for companies with revenue growing at about 10% per year, or over 10% per year, I probably should say. So look at Woolworths results because of what happened with their revenue over the past year. I'll touch upon the valuation of this company right now. I was a little bit surprised about the valuation, about the PE ratio in particular, because the PE ratio of Woolworths right now is a sort of PE ratio you might find for quickly growing companies. Also touch upon whether I think Woolworths is a high quality company or not. In fact, I'll talk about that right now. So is Woolworths a high quality company? Now, Woolworths will never go broke. Now, there's no guarantees in life, but that's an almost certainty. Woolworths will never go broke. If it does, we have significant problems in this company. And if it does, I'll probably be backing my truck up to buy Coles shares. And I don't think we can buy Aldi shares unless they're listed on the German exchange. And what's the other company? The one that owns IGA. I'll probably buy that company as well, because I think the only way Woolworths goes broke is if something significant happens in the world, super volcanic eruption, Yellowstone erupts, that's something like that, or if there's complete mismanagement in this company. I think the mismanagement of this company is a fairly low probability. So just based off the fact that the likelihood of this company going broke in the future is really, really low, you have to assign a high quality to this company. But the other things I look at in determining whether a company is high quality or not is the growth in revenue, growth in profit, that sort of thing, return on equity, return on invested capital. But when you look at the growth in revenue for Woolworths over the past 10, 15, even 20 years, we don't see this company growing all that much. In fact, over the last 5 years, it's been growing between about 2 and 3% the revenue per year. And that should be our expectations for this company. This is a fully mature industry. The supermarkets is a fully mature industry. And the only way we're going to see growth in that industry is through population growth. And population growth we would assume would be maybe 2 to 3% per year, which is the sort of growth I would expect with Woolworths, unless the company completely changes their business model. And I'm not sure why they would change their business model. So I don't expect Woolworths to grow all that much over the next 5, 10, 20 years, so 2 to 3% per year. And that simple fact, I would not assign a high quality to this business. The other thing is the dividend yield of Woolworths right now is less than 3%. So even those income searchers looking for some good dividend yield companies, Woolworths doesn't really have a high dividend yield. And in fact, I'd probably be looking for companies with a dividend yield above 5%. And the only way Woolworths will get to above 5% would be if their share price halves from here. Now, before we get to the financial year 22 results for Woolworths, I just want to look at the weekly chart just to see where this company has been in terms of their share price. Over the past 10 years, yes, this is a 10-year weekly chart. The first thing that really stands out to me is that Woolworths share price tends to go on long trends. We saw a trend from start of this period all the way to mid-2014. Share price was in a well-defined uptrend. Share price reached a high of about $34. And then things turned around. And the share price moved into a well-defined downtrend that lasted 2 years. And during this period, between 2014 and 2016, was a period where this company underwent significant stress to their operating margins. I'll show you the history of operating margins for this company later in the video. I'm not sure why the company saw significant decreases in the operating margins, but it had an effect on the share price. And in fact, the share price more than halved, or about halved, during that 2-year period. So that would have been a shock to Woolworths shareholders who thought this company was a defensive stock, who would think that the share price of this company wouldn't change all that much. It did. It fell from $34 to a low of about $18 in the middle of 2016. And then the business turned around and the share price moved into an uptrend. And that uptrend lasted from the middle of 2016 all the way to the start of 2022. But we have seen a little bit of volatility come into the Woolworths share price. And the share price right now is going sideways if you take into account this volatility. And you can just see that with the moving averages, they've come together and moving sideways. So right now, there is no trend to Woolworths share price. It could go up, it could go down from here. I just don't know. No one knows at all about the future of Woolworths share price. I think the more likely scenario moving forward, and this is just based off probability, is that we will see a share price of this company move into a downtrend simply because of the valuation of Woolworths right now. But that's not a certainty. That's just based off probability. Now to financial year 22 results for the company. Revenue did grow almost 10% from last year, up to 60.8 billion. Now, this company, just like most other supermarkets in the world, have really low operating margins. In fact, probably I'd say the majority of supermarkets have less than 5% operating margins. That's why profit for Woolworths is only $1.5 billion. And I'll show you the operating margin history for Woolworths over the past 20 years. And you'll notice that this company does go through margin contraction, margin expansion at times. And that's very important to the profitability of this company and also to the share price movement of this company. And that's why the share price fell significantly between 2014 and 2016, all to do with operating margins. Now, some platforms and some websites might show financial year 22 profit for Woolworths as about $7 billion or $8 billion. That's because of an abnormal. I'll talk about that later in the video. But the real profit for this company was $1.5 billion. Operating cash flow, $3.4 billion. I'll also talk about why there's a discrepancy and difference between the profit and operating cash flow. It all comes back to depreciation, amortization, that sort of thing, and capital expenditure. Earnings per share, $1.24. You compare the share price to the earnings per share, and right away you'll notice that the share price is about 30 times earnings per share. Yes, the P/E ratio of Woolworths is about 30 or just under 30 right now, which seems a little bit excessive for a company that is not growing all too quickly. In fact, usually I assign a P/E ratio of 30 to quickly growing companies, and I wouldn't call Woolworths a quickly growing company at all. And just to prove my point that Woolworths is not a quickly growing company, here is the company's revenue over the past 12 years, going back to 2011. So no obvious trend in revenue over time. You will do see a little bit of lumpiness here. Some years the revenue does come down. So we saw revenue come down between 2014 and 16. And again, that was because of the compression in operating margins. But over time, revenues do slightly go up for this company. Last 10 years, revenues have increased 0.1%. Last 5 years at 2.3%. Last 3 years at 2.7%. One of the reasons revenues have grown over the last 5 years is because the operating margins have started to increase. So we are seeing operating margin expansion, but there's only so much this company can increase their operating margins until they start coming down again. Have no idea when that's going to happen. It could happen in the next year, could happen in 3, 5, even 10 years. But when that does happen, you will see the profit of this company come down. You'll also see the share price come down a fair bit as well. Now, I just want to break down the revenue derived from different divisions of Woolworths here. So we have 4 divisions: Australian Food, which is Woolworths Supermarkets; Australian Business to Business, not sure exactly what that is, but it is quickly growing; New Zealand Food, which is probably New Zealand Woolworths, if they call it that; and Big W. Majority of revenue for Woolworths is from Australian Food or Woolworths Supermarkets. In fact, 75% of the revenue comes from Woolworths Supermarkets in Australia. The next biggest revenue maker is New Zealand Food. The next biggest is, or third biggest, is Big W. And the last place is Australian Business to Business. But that is the quickest growing sector or division of this company. In fact, revenue grew in the Australian Business to Business division by 224%. Australian Food at 4.5%. New Zealand Food at 5.8%. And Big W actually contracted revenue by 3.3% over the past year. So altogether, revenue for Woolworths grew at 9.2% this year. And most of that growth, or a lot of that growth, was because of Australian business to business. So you really have to understand Australian business to business to come to the conclusion whether Woolworths could continue to grow at 9.2% revenue growth over the next 3 or 5 years. Maybe this growth in Australian business to business was a one-off in this financial year. Now onto the cash flow statement. And in the next slide, I'm going to show you the reconciliation of the operating cash flow to the profits. And the best way to find that note, which is note 4.52, is if you go to cash flow statement, right next to the net cash provided by operating activities, you see a note 4.5.2. Whenever I see that note there next to the operating activities, I know more than likely it's going to be reconciliation. I do like looking at the reconciliation. I'll tell you why in the next slide. So main things I'm looking for here is operating cash flow and also free cash flow. You get free cash flow by minusing capital expenditure from operating activities, or cash flow from operating activities. And Woolworths does tend to be a capital heavy company. In fact, in the past year, past 2 years, they spent $2.4 billion in each year on payments for property, plant, and equipment, which is capital expenditure plus intangible assets. So when you start at operating activity cash flow, $3.4 million in this year, which was down a bit from last year, $4.6 billion in financial year 21. So if you minus that capital expenditure from operating activities cash flow, you get free cash flow of about $900,000. But the story doesn't end there. And in their presentation, the company did mention that net cash outflow due to investment and capital management. What is that capital management? So that investment was the capital expenditure. I'll talk about capital expenditure later in the video. I like capital expenditure to be broken down into capital expenditure for maintenance, capital expenditure for growth. And the company actually did that in the presentation. But what is this capital management? Well, they decided to do a share buyback, and they spent $2 billion on a share buyback. My question is, why did they do a share buyback? Typically, and the best sort of reason to do a share buyback is if management believe that the company's valuation is lower than it should be. And I have a hard time believing that Woolworths management think that this company is undervalued right now with a PE ratio of less than 20. So I'm not sure if this was the best capital allocation decision made by Woolworths. Now, if you disagree with me, I'd love to hear why you think this share buyback was an awesome reason, an awesome capital allocation decision. But based off the capital expenditure, based off this share buyback, that's the reason why there was a net cash outflow for the year for Woolworths. I probably should have also mentioned, looking at the cash flow statement, is that Woolworths actually increased their borrowings, increased their loans over the past year. And that doesn't make sense to me why you would increase your borrowings or your loans while doing a share buyback. Why not just not do the share buyback and not borrow any money? And so I just don't understand some of these capital allocation decisions made by Woolworths management, but they're the ones making the big bucks. They're the ones making the important decisions. I'm just analyzing their decisions, and I could be completely wrong. Maybe these were absolutely awesome capital allocation decisions made by Woolworths management. Anyway, back to note 4.5.2, which is the reconciliation of profit for the period to net cash provided by operating activities. I like this reconciliation because it's very similar to the cash flow statements you'll find in American companies. They start at the profit, work their way back to the operating cash flow. And you'll notice that the profit for the period stated in the reconciliation is $7.9 billion, which is significantly different than the profit I mentioned earlier in the video of $1.5 billion. So why there is a big difference? Am I completely off my mind? Was the profit for Woolworths $7.9 billion compared to last year, $2.1 billion? So this company is growing at a significant rate. No, you got to take into account one-offs or abnormals. And that abnormal for the year and why the profit was $7.9 billion was a gain on demerger of Endeavour to the tune of $6.4 billion. You have to take that away from the profit for the period. That's why I got a number of $1.5 billion. And then the other things you got to take into account here to get from that profit now at $1.5 billion to get the operating cash flow is you got to look at depreciation and amortization. This company has pretty high depreciation and amortization, $2.4 billion for the year. So that means we're up to $3.8 billion. And then you got to take into account changes in working capital, which is increases, decreases in inventories, trade payables, and trade and other receivables. For instance, Woolworths decided they need to increase their inventories by $343 million. That's why it's in brackets, and that is a cash outflow. So if you take into account all the changes in working capital, that's how we get a number of $3.4 billion in operating cash flow. One thing I really like that Woolworths did do is they broke down their capital expenditure into maintenance, which they called sustaining, and growth. I like this because I want to see how much a company spends just to maintain their operations. And for Woolworths, that was $1.4 billion in financial year 22, $1.2 billion in financial year 21. So this company spends a lot to maintain their operations every single year. And their growth capital expenditure was around about $525 million for this year, $528 million for financial year 21. So they haven't grown their capital expenditure for growth over the past year. They've also broken down the capital expenditure for growth into 4 parts. So they spent $111 million on new stores, $121 million on digital, $147 million on e-com, and $146 million on other growth. And there has been a significant increase in growth expenditure or growth capital expenditure for e-commerce from $85 million to $147 million. So Woolworths is spending more on that part of their business, their e-commerce. So they probably expect e-commerce to grow quite significantly over the next 5 to 10 years. Whenever a company releases their financial year results, a lot of times they will also include an outlook for the next financial year. And Woolworths did exactly that for financial year 23. So some interesting statements within their outlook here. So they did have a statement in regards to food inflation, saying or stating it's showing no signs of moderation in the short term. So there is a possibility we'll keep on seeing food prices increase in the short term. They also mentioned that Australian food sales broadly flat over the first 8 weeks of financial year 23, up 0.5%. They also mentioned that New Zealand food EBIT is actually materially below prior year due to ongoing disruption and team absenteeism. And they also mentioned that Big W has turned around in the first 8 weeks of this financial year. Remember, Big W sales were down from financial year 21 to financial year 22, but they're up 30% or just under 30% in the first 8 weeks of financial year 23. Now on to the valuation of the company. This is where I question what's happening with Woolworths share price right now. P ratio is at 29.5. That seems excessively high, in my opinion, for a company that is not growing all that much. If I saw a high growth company with a P ratio of 30, I probably could justify that. So either the market is paying a significant premium to this company because they believe this company or Woolworths is a high quality company, or they expect significant growth in the next 5 years to justify this high P ratio. So again, if you have any reasons why Woolworths has a high PE ratio right now, if you think it's justified, I'd love to hear your opinion. So leave in the comment section of this video. Price to sales ratio is 0.72. Price to operating cash flow, fairly high as well, 13. We also have a look at the price to operating cash flow history for this company over the past, I think it's 15 years. And the price to operating cash flow for Woolworths of 13 is historically a fairly high number for this company. And lo and behold, this is the price to operating cash flow for Woolworths over the past 22 years, going back to the year 2000. And what I'm comparing here is looking at the valuation metric right now, which is the price to operating cash flow, and comparing it to what we should expect for this company. And if I see a comparison right now, which is on the high side or low side, that could be telling us whether the company is expensive right now compared to what we should expect, or cheap right now to what we should expect. For instance, if the price to operating cash flow for Woolworths gets above 14, it doesn't stay there too long. We saw it get above 14 in 2007. In fact, it went as high as 20, and then it fell quite sharply. In fact, it fell all the way from about 20.5 to less than 9 in about 1 year's trading. We also saw the price to operating cash flow get above 14 for a brief period in 2014, for a brief period just before the COVID-19 financial panic. And just recently, we saw the price to operating cash flow just get above 14 for a very brief period of time. And right now, Woolworths price to operating cash flow is just in between 13 and 14, so on the high side. On the flip side, whenever we see the price to operating cash flow for Woolworths get below, say, 9 or even 8, that is on the low end. That would be telling us that the valuation of Woolworths is looking really attractive at those levels. But usually if the price to operating cash flow or the valuation metric is on the low side or towards the bottom of the range, that is telling us it's probably a lot of negative sentiment around the company at that point in time. So if we go back to 2016, the price to operating cash flow Woolworths was as low as about 7.5, which was the lowest we've seen in the past 20 years. That's when the share price reached its lowest value over the past 10 years of about $18. And that was the best time to take a position in this company, because at that point in time, there was a lot of negative sentiment around this company because of a contraction in their operating margins. And talking about contraction in operating margins, let's have a look at that right now. So this is the history of Woolworths operating margins going back to 2007. So you'll notice between 2007 and 2015, operating margins of this company was increased from 5% to 6.7%. So I have heard that Woolworths back in 2013-14 had the highest operating margins amongst all supermarkets in the world. And whenever a company has pretty high operating margins in this highly competitive industry, there will be the threat of increased competition. And we saw that threat of increased competition in 2015, 2016, and that's why the operating margins for this company fell from 6.7% to 2.8% in 1 year. And ever since that low point in 2016 of 2.8% operating margins, the margins have slowly started to increase. And right now, the operating margins of this company are around 5%. That was in financial year 21, not financial year 22, because this particular graph from Ticker.com includes that abnormal profits. So we saw, well, this graph would have had operating margins something like 20% for financial year 22, which is completely wrong. But the main thing here is operating margins are starting to climb again. The question is, how high will they get? But you won't be able to see, and this company won't be able to increase the operating margins forever. Eventually, they'll get to a point, more than likely above 6%, and then there will be some pressures on those operating margins, and that's when we're more likely to see a significant drop in operating margins again, like we saw back in 2016. And I think it's very important to keep an eye on operating margins if you are a shareholder of this company. You don't want to see pressures on operating margins because that will be negative for the company's profits, for the revenue, and also for the share price. Talking about Woolworths share price, this is the daily chart going back to July last year. So almost a 1 year daily chart. And to be honest with you, nothing at all is happening with Woolworths share price right now. There is no trend. So there is a lack of trend. We already saw that with the weekly chart, and this bears out also with the daily chart. Share price just going sideways. You can see short periods of time when the share price goes up and goes down. That's very normal in these sort of consolidation period. So when the share price gets above about 40, say $42, or we'll say $41, there will be a little bit of selling pressure. When the share price gets below about $33, $34, there's going to be a little bit of buying pressure. And we have seen that play out over the past year. So at this point in time, I have no idea whether the share price of this company is going to go higher or lower, simply because there is no trend in the share price of this company. That's all I have for this video, looking at Woolworths financial year 22 results. If you have any questions, any thoughts, any opinions on Woolworths, if you think this is a high quality company and you don't understand why I don't think it is, leave your reasons why in the comment section of this video. I love to hear different opinion than my own, because that's how I learn. That's how we all should learn to become better investors. Take on board different opinions. So just leave your different opinion in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.